All right, good enough. Well, welcome everyone. I'm Victor Lund. I'm the CEO of WAV Group. We're a consulting firm that works with real estate brokerages on mergers and acquisitions. I've assembled here our head of M&A, George Slusser. Nice to see you, George, along with two executives from companies that have been very active in the last 2 or 3 years or longer in mergers and acquisitions. I have Chrissy Oliver from Compass and Matt Rand from the Howard Hanna family of companies, if I get that right. Everybody just uses Howard Hanna. I like the long version. So it's great to have everybody here. I think 2025 is going to be a very interesting year for M&A. We're certainly still dealing with some headwinds related to overall market activity. We're probably slotted in. I think the last number that I liked was at a transaction pace similar to where we were at in 2009. So an incredibly low year in 2024 for overall transaction volume. We don't know with the current administration what benefits we might see in the real estate industry. Obviously, housing and housing affordability has been a really important element, and nothing values a broker more than transactions. So we all understand how the economics of our business works, and we hope for the best. But we are where we are, and 2025 is still going to be a spirited year. Companies are, more likely to see 10-12% growth if they're effective. Companies that are growing through acquisition are going to grow much more quickly in that. And two of our panelists here today have experienced that over the last few years. So we're excited to get their input. So I'd like to just start things off by introducing the panelists or having them introduce themselves. There's an interesting little factoid that you may not know, which is Chrissy Oliver. She was born into the real estate industry. Her family and grandfather started their business, and the same is true for Matt Rand. So Chrissy, welcome. We'll let you go first if you want to just give us a little bit of your background and your role at Compass, and we'll get started with that.
Thanks, Victor, and thank you for having me today. It's great to be here and great to be alongside Matt. We've met many times in the past, and our family kind of paths have intertwined a few times as well. As Victor said, I run the M&A team at Compass. I've been with Compass for almost 10 years, in my current role for the last 7. And over that period of time, we've been very active in the M&A space, both on the brokerage and the ancillary services side as well. So I work really closely with our leadership team and our regional operations teams, our growth teams, to identify opportunities, and then partner with our new partners throughout the deal and transaction process, all the way through integration. We have a robust integration team at Compass as well that helps to make sure that these transactions go smoothly past the closing date as well. Thanks, Victor.
Excellent. Matt, you're up.
All right. Thanks for having me. It's good to see you. It's great to see Chrissy. We do go back a long ways. And, I came from a family business that my mom started, which was Rand Realty. In 2020, we partnered with Howard Hanna. So I've seen, we grew through acquisitions our entire career and our entire history of our business. And then we were acquired by Howard Hanna. So I've seen this from both directions. Today, I still oversee what was our family business in the tri-state area of New York, and Howard Hanna's operations across upstate and Western New York.
Excellent. Thank you so much. So our head of M&A here is George Slusser, and George is going to lead us off. He's going to just really talk about his role here at WAV Group and the M&A team and the kinds of things that we do, and then really provide an overview about how companies become valued and how they understand and manage their value. So George, that's the number one question everybody asks is what's the multiple of EBITDA my brokerage is worth? So with that, I'll let you kick it off.
Thank you. Not too difficult to start anyway. Thanks, Victor. I'm just going to start out with just some M&A basics, I think. So at the WAV Group, we do both the buy side and the sell side advisory, but we spend a lot of our time on valuations. And that's what's most important, we believe, from a beginning standpoint is, what we get asked, what is my company worth? And then really, how do you find out? And so that's what we do in the valuation process. And what we try to do is really ask, what would the profitability be if you didn't own the company, or if this person didn't own the company, but a third party or an absentee owner owned it? And that's the most important thing, is to look at it from arm's length standpoint. Are there additional expenses that'd be required? If you're an owner of the company, would you work for that same compensation you're currently receiving? And we get often asked in evaluation, said, no, I wouldn't work for that. Said, then we have to add back some expenses because the person's not receiving fair compensation for the amount of time they're invested. And so we typically will almost have to go through every line item to really determine if it's an adjustment's required, additional expenses, or if we need to add back for profit. And there's just a few things that I'll point out that are typical that you'll want to look at when you're looking at your own company to sort of create it cleanly and smoothly so people can look at it. But owner's compensation is probably the biggest thing, especially in small companies. So the owner may be compensated for the management of the company, or in many cases, they're not compensated at all. And they're doing the training and the recruiting. And if they were owned by another company, you'd have to pay for that service. So that's an important thing to look at within your own company. And then also it's owner production or family production. Many times the owner will keep 100% of the compensation or the commission that comes in, or they'll leave it all in the company. And so we have to adjust for that in many cases. And then a lot of the buildings are owned by the company or owned by the owner or their family. And so you're either taking out way too much rent or you're not enough rent. And so we have to adjust that. So there's always private company expenses, we call them. And people do excess travel. They'll have homes in there, not homes, excuse me, cars in there. We've seen boats in there. We've seen RVs in there, all types of things within the company that the IRS allows, but we want to take that out as an adjustment for profit. So that's really what we have to look at, almost line item by line item. And that's what you can begin to look at to sort of clean up your books and your financials to know what it would be if a third party or an arm's length owned it. And we'll let Matt and Chrissy take a look at this or jump in a second. But what we believe typical buyers are looking for and what we do with our buyers, they want to look at the historical growth. So we're always looking at the last few years of what's happened. And we always like to see year-over-year growth. Not always possible, especially as Victor said, 23 and 24 were difficult years. And then the certainty of the earnings. How certain are we that they can continue to grow year after year after year? And that includes your management team, the quality of your agents. We look at the quality of the earnings so that no one agent has more than 10% of the total GCI, or a team. In many cases, a team or an owner may have 30, 40, 50% of the total GCI, and that makes it difficult for a buyer. And then there's the assets. Everyone looks at pending sales, obviously the agents, the furniture and fixtures, in the listing inventory. But we did a webinar I think a month or so ago on the new metric for many companies, which is the buy side agreements. And hopefully Matt can talk to this because they've been tracking the buy side for many years. But like listing agreements, you can now track up to 10 different metrics on the buy side. And we think in mergers and acquisitions, this is going to be really important in 2025 and 6 and 7, that you actually have buy-side agreements that can be valued just like a listing a contract can be valued. Before, we would just have to sort of interpolate, what percentage of income came from the listing agreements and what did those mean. But now we can look at both sides. So I think that'll give us a little even better value of where companies come from or where companies really are in the scope of their earnings. And so you can look back at that webinar, because I think we recorded that one, but we came up with 10 different metrics that you can track on the buy side agreements. So
yeah, George, what we'll do is have Jason put that link into the chat here. And then when we send out the email after, we'll certainly pass that along.
Yeah, I think that'd be very helpful, because when you're looking at selling your firm, it's really important to do evaluation. But we think, even not us, any professional person that's doing evaluation, you should get that done at least on an annual basis. It's very important for you to know the investments that you've made. Are they working out? Are you headed in the right directions? Can you do anything else to adjust it? But everyone should look at their firm as an asset, which I'm sure you do, but you always want to know what the value of that asset is. And in many cases, it's the most valuable thing you own. So when we get involved in a valuation, we really want to get down to what true adjusted earnings are. So every financial statement we look at is different, and very rarely, if ever, is one correct, because you have to do those adjustments. And so if you're in a situation where you have a buyer and a seller and we're involved or not involved, what we always try to do is to get agreement on the adjusted earnings. What we've always found is it's impossible to do a deal if someone believes their earnings are 200,000 and the other person thinks it's 400,000. There's no amount of multiple or adjustments or anything that will get you to a transaction. So what a third party can do for you is to really come to agreement, and are these the true adjusted earnings? And if the buyer and seller can agree on the true adjusted earnings of the company, then it's just a negotiation of what's the correct multiple, purchase price, terms, and all. But without a good valuation, I believe it's really, really difficult to do a transaction. So that hopefully will lead into our wonderful panelists today who, live this every day, of what it takes to do a proper merger and acquisition. And most of you, I assume, are sellers on the call or potential sellers. So hopefully we've given you a little insight as to what it takes from a seller's perspective to really get a good idea of value before the buyers come into the fold.
Yeah, I guess I should just contribute. Like, you can have WAV Group do evaluation for you. Steve Murray, Real Trends, they're another popular company that do valuations. I think we charge about the same. If it's under 5 offices, it's usually around $5,000 or less or whatever. Pretty reasonable amount of money, but it's just important to have. Chrissy, maybe you should just weigh in on your perspective. You've had to walk into deals where the owners have no understanding of the value of their business or what they'd want for it. So, you're sort of, how does that conversation start? And how do you think it disadvantages the seller when they don't have any understanding of value?
Yeah, there's definitely been several instances of that over the last several years. And I think, honestly, valuation has evolved a lot in the last 5 years. Think about how the market's evolved. The valuations of these companies has evolved alongside that. Honestly, I think there's kind of 2 ways that not understanding the value of your business can play out. One is, as George was just mentioning, totally mismanaged expectations. If you believe the valuation is 2 times what the buyer believes, everyone just wasted a ton of time even considering this transaction. On the other hand, if you have no clue where your company is valued, you've actually just given away all your leverage to the buyer. And I hate to say that because I'm negotiating against myself a bit there, but I actually prefer to do transactions with folks that have a good understanding of the value of your business. I want to pay a fair price. Compass wants to pay a fair price for your business. And if you understand where your value drivers are, which will come out of these analyses that you just described, Victor and George, it's easier for us to understand how does that play in, like how do those puzzle pieces fit into Compass in our broader strategic objectives. And then also, I think some of that will play into what the motivations are for you as a seller and what are you trying to get out of the transaction as well.
For sure. I just can't stress that enough for business owners to do that. One of the things that what George was talking about in terms of the adjustments that you make, it's appropriate as a business owner to manage your expenses in a way that provides you tax optimization for your company. But that isn't the way that an acquirer would look at your company. They look at it very differently. So understanding how to do that is a real art, but it's also just some simple math. George and I wrote a book, and it has a companion workbook that everybody is going to get for free who registered for this. We're going to send it to you. It's literally a spreadsheet where you can go down and you can make the adjustments yourself to gain optics into what it is. But, probably one of the more interesting ways to look at this, and Matt, you brought this up in our prep session, is when you're thinking about an expense, if you think about it through the lens of what the value of your company is, the math is different. Can you explain that?
Yeah, well, I think if you're, I think you're absolutely right that you should get valuations on your business. And I think people get shy. They're shy to share their financials. Maybe they don't even look at them very often or very deeply. So they don't even really know what's in there. So going to a third party like you guys and getting an analysis on it, you know, it's what you would do if you were thinking about what your house is worth, right? Like we do that as an industry. You should do that with your business. And, you know, when you've got expenses on there that you are going to sell your company for 3 to 5 multiple, that's 3 to 5 times the profit. Every dollar in spending that otherwise could be profit, you're losing 5 times that potentially. So, so you're right. You run your business better when you are really tracking these numbers and running to these numbers. So even if you're not thinking about selling, you should be more disciplined in how you operate your business. Because if you ever then decide you want to do something, you've already done the hard work. The worst is when you meet with someone and they're looking for a Hail Mary. That's why they're looking to sell the business, right? Like selling your business is the touchdown at the end of like a great drive, right? Like it's the ultimate success of a business owner. Sometimes I think people in small businesses and in our industry tend to think that it's the sign of failure, right? It's the sign of the ultimate success. I mean, you build a business, so someday you could sell and it would be worth something, but you have to run it like it's going to be worth something.
Well, and you and your family, you guys, so you kind of were transitioning ownership from your mom over to you and your brother, right? Or other siblings? Was it just the two of you? Sorry, I don't know.
Yeah, there's 4 of us, but we've been in the
Okay.
business at different times, but yeah.
Yeah. So you guys were constantly understanding your valuation even before you joined the Howard Hanna family of whatever companies. But you guys were doing that as a regular and basic discipline, right?
Yeah, and you know, it's funny because the advice that you'll get if you're thinking about, you know, even looking at selling your business is, you know, keep running it the way you always ran it. What we sort of learned through the process is run it better all the time, actually. And then you don't have to change anything if you decide you want to do something, because we were not planning on selling. We were just had an opportunity to look around and found ourselves, you know, intrigued by the prospect. So, you know, we were looking to grow, and we found that, you know, we could grow faster and better and with less risk if we partnered with a larger company. So you never know what the motivations might be or when the opportunity is going to present itself.
For sure. So Chrissy, why don't you just kind of tell us a little bit. You guys have done how many trades in the last 6 months? I mean, you've done some huge trades, right? But do you have a lot of tuck-ins and smaller trades and things like that you've been doing? Is there a count? Do you keep a number on the wall?
So we've done a number of larger transactions in the last 12 months, 12 to 15 months. We've also continually are looking at kind of what you described, Victor, smaller transactions, more kind of boutique, single office, 2 office sort of opportunities. We call those walkovers at Compass, and I partner directly with our growth team on those opportunities. They're very regional, as you can imagine. You know, understanding the nuance of those markets is critical when you're bringing over and merging with like a really strong independent local player. And we try to do them as walkovers because it actually is a much more streamlined transaction process for the counterparty. We can paper things in a much simpler way while still providing kind of that value and that upside for our new partner. And that's why we kind of run things through that regional team and our growth team that way. I wish I kept count of those. It'd be like in the dozens, if not hundreds, in the last couple of years. There's been a lot of opportunity in that space. I think we're seeing a lot of folks that, to Matt's point, understand that the opportunity for growth in this market, there's much more scale when you're part of a larger organization. And so I think there's 2 main drivers in those discussions from the counterparty's perspective. One is some people are just tired of owning and running a business, and being able to offload some of those administrative kind of more burdensome tasks so they can focus on their business, which may be selling, or perhaps they want to get out of the business. That's a huge opportunity for them. And then I think some other folks are just feeling like the rat race to keep up from a technology and an innovation perspective is so costly and just mind consuming that they'd rather partner with a larger organization that has greater resources to think about that so that they don't have to.
Yeah, Matt, your family would have had to address the DOJ and the settlement stuff over the commission litigation had it not been.
Right. It was, yeah, that was nice that I didn't have to be in those meetings. So, but it's, I agree 100% with what Chrissy's saying. I think especially, I say all the time to smaller brokers that, are thinking about doing something that, when you're running a smaller mid-sized brokerage, you're really doing 4 jobs, right? And you're probably selling real estate, in a smaller company. You're managing agents and growing and developing talent. You're running a business, which, last year involved all that compliance work, but just meeting with attorneys and accountants and all of that stuff that you have to do to just operate the business. And then it's a whole nother job of running marketing and technology today. And for a lot of those brokers, they either love selling or they love managing and developing agents, and they have gotten bogged down in all the other crap now. That's not their skill set or not what they love. And so being able to shed all of that, partner with a larger company that has all of those resources and all those tools, and be able to focus on something. We had a company that joined us, and the broker stayed on as a manager, and we went to an event where it was a futurist talking about technology and everything that's happened. And she leaned over to me and she said, "That's what I have you for. Like, I don't need to do this." So it's, I think you have a lot of different reasons why people, and then in the larger companies, you're dealing still with the technology investments and constantly having to redevelop. You think you just finally got it all perfect, and then everything changes again. So you're still dealing with those hassles. And of course, like you said, the settlement and everything was a disaster for large companies last year. And I think people are looking at it and saying, I even as big as I am, I need to be bigger.
Yeah. George, one of the things that you have been active in recently is franchise brand on brand mergers, as well as companies rolling into franchises. Can you talk a little bit about those 2 transactions and how they might be different from selling to a Compass or a Howard Hanna?
Yeah, with a franchise situation, a lot of times they won't allow you to buy another company that's not in your brand or in another franchise, because they're pretty specific on outs and how long they have left in their agreement. But the last couple of years, many of the franchises have been allowing consolidation because of the economies of scale, obviously, that everyone knows about with a merger and acquisition. And so I think it's really only been the last 2 years that most of the brands now are even encouraging consolidation, trying to make everyone stronger as a franchise brand within their brand. And so we've seen just an exponential increase the last 2 years. And I think going forward in same brand mergers. And I think we're going to continue to see that because the franchisor now realizes it's better to have, 2 strong brands in a market rather than 10 little ones running around that aren't strong enough to survive. So that's a dramatic change in the industry from a M&A standpoint.
So, and this is probably the biggest area of M&A that we see occurring right now, which is, the franchisor kind of knows what the financial health is of their franchisee, and they can look at other companies that are in a market area and say, "Hey, you're really good at recruiting and you're really good at deal doctoring. Why don't you guys get together and build a company that's going to be more successful under the flag of our brand?" And so that's been certainly popular. Another thing that franchise organizations have been providing is some financial considerations where they participate in covering some of the overhead of bringing an unbranded company into the brand. You want to talk a little bit about how that formula works?
Yeah, and they sort of factor the royalties going forward. And so some of them are even offering for recruiting and for teams where the parent will bring revenue in, or excuse me, the franchisee will bring revenue in, and the parent will give them some sort of break, either concessions on the royalty going forward or actual cash up front. And many times it's in terms of a loan that's forgiven over time. And typical is a 10-year development advance note, they call it, in many of the franchises. And so if the GCI stays the same or gets more, it's forgiven every year, 1/9 of it or 1/10 of it per year. So there are a lot of opportunities, and they're trying to be, the franchisors are trying to be I guess, as open-minded as possible to compete with the Compass and the Howard Hannas of the world. And they need to, because all their companies need to get larger from a scale standpoint to be able to compete in the new world of real estate.
Well, fortunately, Compass isn't buying agents anymore. It was a growth strategy that's had its day, but I do recall hearing a few Anywhere executives saying, well, I guess we have to do that too in order to remain competitive. So that fortunately is in our rearview window. Matt, now you when your company joined Howard Hanna, you became like the regional manager of the Northeast. Do I have that right? Or how much of I mean, you just had your role expanded, right? You have more area?
Yeah, so I'm overseeing the New York operation, which was which was an acquisition years ago of Realty USA and Nothnagel across Western New York and upstate New York. And then still the Hanna Rand company. So we've co-branded what was the Rand company, and we've got Hanna Coach out on Long Island. So I'm overseeing that, but obviously Howard Hanna is in 13 states. We're very active in a lot of other areas on acquisitions, and they've got a real appetite to continue to expand into new markets.
So
they did a big deal in North Carolina, down Hilton Head, which was a new market for Howard Hanna, and we have done a number of expansions in central and southern Ohio. So the boundaries of Howard Hanna just keep getting wider, and finding like-minded independent brokers that want to either sell entirely to Howard Hanna or do what we did, which was a partnership deal where we still retained ownership of our, partial ownership of the company, but also were able to take money off the table at the same time.
Now, but I know that Hobie Hanna, who I guess is your boss, said Matt's done an incredible job of rolling in and acquiring a bunch of small businesses in and around. I think he calls it a land and expand model, where you're continuing to introduce more firms to build more larger, more robust offices, as well as planting a seed in a challenger market where you might be able to grow strategically. Is that something that's handled regionally, or are you doing more of that for the company?
Yes, I am. And it's, when we joined in 2020, we did 10 acquisitions, walk over some new markets, some roll-ins in like the first 2 years. So, part of it is that we had a lot of relationships, and we had always grown through mergers and acquisitions, but we didn't always have the risk tolerance, right? So, suddenly things that were scary for Rand Realty to do were not scary in the context of Howard Hanna, and also having access to, greater financial advisement, right? Where they could really analyze deals at a higher level, where, if Hanna is saying it's good, it makes me feel a lot better than if like me and Joe are just flipping a coin, so it's so that has really opened up opportunities, and the Hanna name has opened up opportunities for us into new markets. So yes, I think that for Howard Hanna going into places like our area, it's really important that the company comes with an operator that's going to be staying on, right? So, if this was just, hey, we want to sell this and everyone's going to retire and leave, where are they going to find the people to run it, right? So in our case, we wanted to be here. We wanted to stay in the business. I think that's important. That's similar to what's happened with FC Tucker Company in Indiana and Allen Tate and in Coach out in Long Island, where partners have stayed in who are the operators, which I think gives a lot of comfort for Howard Hanna to say, let's go into this market. We already know how it runs. We're not going to go and disrupt it. We don't need to, right? As an independent kind of family-owned entrepreneurial business, that gives you, the flexibility to kind of reinvent yourself in each place that you go to to match what's on the ground.
Chrissy, maybe you could weigh in on that too, because it's rather interesting, because basically what Matt just formulated there is that Howard Hanna, like Compass, provides brokerage as a service, but leadership and sales in the local market area and those types of things are highly valued in an organization. Can you talk a little bit about, how, what your considerations are relative to whether or not they're staying or going, and what the continuation plan is going to be, and, how easy it is to match culture within your organization versus your acquisition partner?
Yeah, it's a great question, and it's honestly something that we contemplate constantly. How do you identify the right opportunities, the right partners from a cultural alignment perspective is paramount to success of a transaction. It's really the thing that we care about most at Compass. So, there are tens of thousands of brokerages in the United States. There aren't tens of thousands of opportunities that Compass would consider. I think that we are really, and that would be a good fit for Compass. I think what's nice about the brokerage landscape in the US is that there's a lot of different options for companies if they are looking to consolidate or partner with a larger firm. And we are very thoughtful around what looks like a good fit for Compass and kind of what that framework is. It's we're a traditional brokerage from a economic model perspective. That's important to us. It's not given the robust support and services that we offer our agents, it just wouldn't work in a non-traditional economic framework from a profitability standpoint. It also probably won't work from a personality standpoint. Like, our agents like that support model, our managers like that support model. And so that's something that's really critical. From just like a personality standpoint, that's something we also screen for. So we are a very collaborative, low ego, solutions minded, also move fast culture. So those are things that we look for. I'm sure everybody on this panel can attest to the fact that during a deal process, you get to know people really, really well, spend a lot of time together. So you figure out whether or not that personality fit is there. And in that process, to your point around leadership, Matt and Victor, like, you really start to understand what people's strengths are. And one of our we call them our entrepreneurship principles at Compass. One of those entrepreneurship principles is maximize your strengths. So how do we take the leadership team that's in place at our new partner and make sure that they're put into positions of success at Compass? So, and it's looked any number of different ways. We've had folks who stayed in exactly the same role that they were in prior to our transaction. And we've had folks that have taken on wildly different opportunities because being part of a larger organization allows them to lean into something that maybe as a single proprietor didn't give them that opportunity. So I think there's a lot of opportunity there, but we do highly prioritize and focus on leadership staying at least a part of the company. We think that that's critically important for messaging and continuity across the entire agent and employee base as we go through the transition process. I've never encountered this, but I would imagine that it's very hard to convince people that you made a decision with them in mind if you're running for the hills the minute you make the announcement. So we really want folks that are going to stick around, help us work through things together, be there for their people. It's shocking news. The folks that are finding out on the day of the announcement didn't have 6 months to think about it. They had 3 minutes. And so having them stick around and be there to help kind of facilitate the transition and make sure folks understand that they were thought about during the process, that their best interests were kept in mind. And here are all the reasons why we think that this is the best next chapter for our organization. It's really critically important. And if you don't have that cultural alignment, it's really hard to land that plane because your answers will just fall flat. So that's where, going back to culture, it's really important that we find companies that we think are aligned. They don't have to be perfectly aligned, but 90% of the way there. And I think some of the unique factors that have come out in that 10% are what make Compass such a kind of robust and diverse organization as well.
Yeah, I can hear Mark McLaughlin through your tone. Don't ever forget that when you when you're making the announcement, it's day one for all those people. You've been working on this thing for months or a year or whatever, and for them it's day one. And I thought it was remarkable how actually 2 times in the last couple of weeks I've heard Robert Refkin mention Thad Wong. Like, he mentioned him when he was on stage at the Inman CEO Summit, and some of the contributions to the overall philosophy and ethos that he's contributed to the company in a very short period of time. And then he made that statement again with the launch of Compass One just the other day. Congratulations on that launch. That was a big pull through.
Yeah, it's exciting.
Yeah, but it was remarkable. I know, George, is it the first chapter of our book that talks about culture?
Yeah, economics don't matter if the culture doesn't fit. Yeah, we agree with Chrissy 100%.
And you want to just translate that into the term breakage and help people understand what that is and why it's so important?
Yeah, so the term breakage we've used for many, many, many years, but you'll recognize it as agents departing. And so that's when it's day one of the acquisition. You want to keep them through at least day 30. And if you can keep them through day 30, they're usually yours to win or to lose because they've accepted and they're not making the change. But as all of you know, on day one, every brokerage in town is going to be calling that agent saying, "Whoa, man, I'm so sorry for you. This is terrible news," and give them all the reasons why it's not going to be a good fit for you guys. And so we always want to retain 95% plus of the GCI from an acquisition is an ideal situation. 90% above is acceptable, but there's been many situations in my past when it's gone below 90%, and then you're in trouble. And it's just not a good acquisition for the seller. It's not good for the buyer, and it's not good for the agents. So breakage is probably a harsh term, but you just don't want to lose agents. And as Chrissy said, the way to lose agents is not to be culturally compatible.
Yeah, no, that's so true. I recall, and I don't know if you were involved in the Realogy acquisition of Frank Howard Allen up in the North Bay, but one of the things that Pacific Union, which is now part of Compass, had prepared long in advance is they had everything set up for onboarding a brokerage. Like, there was a playbook. We've got signs to order, we've got business cards to order, we've got everything that needs to be done was a checklist item. Vendors were lined up and they were ready to go. And the minute that announcement happened, Pacific Union just descended on Frank Howard Allen, its agents and offices, and literally leased an office and opened it that day and moved them across the street into that office. Matt, I'm sure you've had some really cool stories about some of your trials and tribulations with M&A. Anything that you could share that would be
Yeah, well, I don't believe in the word breakage, so
anything less than 100% is no good.
I want everybody to stick around. I think it comes down to it's that cultural fit and it's preparation, right? I think what you talked about, the playbook that they had, I think the playbook on the other side, when you're making an announcement, is you've got to have everything done ready so that the agents aren't put into any kind of like limbo. I think that we think
having an ISA agreement on every agent who works at your company, that's an important thing to have.
Right. Yeah, like be ready to go. Right. So I think there's, if you don't know, we always say agents don't like change. And it's not that they don't like change. It's that they don't like the idea of change. If you tell, agents basically manage change for a living. Like, this is their job. They're actually really good at change. That's what they do for people. And so when you tell them everything is changing right now, they just deal with it because they're those kind of people. When you tell them everything is changing in 6 months, they freak out for 6 months, So you've got to have it. So if this is where the stuff usually is in the office, the new rebranded one is in the same spot when they get back to the office from the announcement, right? All the technology, if they're losing any technology because they're coming from a brand and maybe some things are no longer going to work because they came from a franchise, you've got to have that stuff in place, ready to go, ready to train right off the bat. So that's where it's really worked well. And I think that preparation, and I think, of course, when you've got the cultural fit that you talked about, you've got to have, if you're selling your brokerage, you've got to know why you're selling your brokerage, that the company you're selling it to is going to offer something to your agents that you couldn't do now. That's the reason to join a larger company, that that you like the stuff that's going to be coming. And when you're excited, then your agents are going to be excited because they believe you and trust in you. And then the other side of that is what you said of people staying. The only disasters, you asked us in the pre notes here about kind of disasters and pitfalls. The only deals we've had that have gone bad are when the broker was not staking around, or they were supposed to be, but then they didn't really actually. And so you can, all of a sudden, if you have to then buy an office and then replace the manager, you don't know the people, you don't know the culture, you're bringing in an outsider. That's too much change for that office all at once. And that just doesn't seem to work. When that broker is sticking around to make sure that they can synthesize the old with the new and be the bridge of bringing agents through that process, that's when it works out good.
Yeah, the epitome of that acquisition strategy, I think, historically has been Home Services of America, who hasn't been super active recently as they were before. Before Chrissy came along, they seemed to be buying every reasonably sized real estate company in the world. But yeah, they were like, no, Fox and Roach, we don't want to change the way you do it. You do it just that way. Long and Foster, you keep doing it. Abby, we're buying your company because we don't want to mess it up.
Right.
So Chrissy, some of those things now, you guys do introduce change, but you introduce it carefully. Are there things that people should be, open-minded to? I know like tech is one of the examples. Like everybody has read in the news and your earnings reports that you guys have invested well over $1 billion in technology. That's, other than portals, I don't know of any brokerage that has made that kind of core development investment. Obviously you want to bring them on that platform, right?
Yeah, and it's honestly typically one of the main drivers on the other side of the transaction as well, which helps. I think that so to Matt's point, Victor, to your point, like we also have a very robust playbook. Our integration work plan is like, I don't know, 600 line items, and then it gets customized from there for every iteration of whatever is unique about the opportunity that we're considering. We spend weeks going through what we call operational due diligence, which is separate from deal due diligence, which is really about why do agents join? Why do they stay? How do you support them? I'm an agent, I got a listing. What happens next? How do I order business cards? What do they look like? Those sorts of things, because it's actually really interesting. The first question we always get is, what will my new business card look like?
Can I still have my dog on it?
Exactly. So in that regard, like being really prepared and having answers to Matt's point is critically important. And when we can, we actually find it's best not to shove technology down the agent's throat. So you don't want to prolong the integration too long, because then they're constantly sitting around waiting, when's it going to happen? When's it going to happen? But if we can have a really thoughtful roadmap, and it's almost like a schedule of events. What's going to happen over the next 3 months? How can I plan for this? When are my signs going to change? When is when do I have to start using different listing agreement? Those sorts of things. Like we kind of map it all out for them. And then what inevitably happens is agents say, we want it sooner. And so then we have to bring the schedule forward, which is what we want. If we tried to shove it down their throat too quickly, it's too overwhelming. They need to run their business. They can't manage an integration right now. So when they start to ask for it, that's when we know we're in a position where we can actually introduce it. If they have not asked for it yet, they're not ready to digest it. So we really try we have this robust plan. We map this out. My integration team hates me every single time because we always end up moving it faster. But at least then we know the agents are ready to welcome and be introduced to the platform and into the other services that the company offers. There are so many things that they love about their brokerage, and our kind of philosophy going into every single integration is first, do no harm. We want to protect what made your company unique, what kept your agents at their desks, what kept them putting your signs in the ground. and then introduce the things that Compass can offer that can help them up-level their business, that can make your employees more efficient, spend more time with your agents rather than sitting behind their desk, those sorts of things. And so it's really about how do we protect what made your company unique, what kept your people there, what do they love most, and then how can we layer on top of that, sprinkle these kind of wonderful things that hopefully Compass has to offer, that can make their lives better as well.
It's awesome. George, can you provide just a quick overview of common deal structure, and then I'd like Matt and Chrissy to talk about the deal structures that that they're operating? I know, like, just start with maybe asset versus merger, that kind of thing.
Yeah, so most of the transactions that we work with are primarily asset. Unless it's an incredibly large company, it's probably going to be an asset transaction. And again, it's good and bad depending on which side you're looking at. But the seller always wants to have as much capital gains as possible. So they do their best to have the furniture and fixtures as low as possible. And you have to have agreement on both sides from a tax standpoint. So most of the structures are asset that we deal with anyway. And then typically it's,
There's a liability component too. I don't want you to skip.
and there's a liability component too. Again, it can be pierced. The veil can be pierced on that, but yeah, it's much better from an asset standpoint from the buyer that they don't have to take on any of the stock issues that could have arisen over the past many years. So there is a liability issue there, and it's in the book if you want to get that and go into better detail. But typically, the transaction is some percentage down, and have seen very rarely that there's not a amount down. People usually have to have some money off the table in the beginning, and typically it ranges from 20 to 30%. And we've seen it as high as 50, and we've seen Compass do 100% in the past in a number of years. And so somewhere in the 20 to 30 is the most of the regional buyers and the smaller buyers. And then there's an earnout based on performance. And it's typically 3 years to 4 years. And it ranges off of company dollar or off of gross commission income. And I've seen some that go off of net profits, but we don't encourage that or recommend that in any way. It's just too difficult, and you have to share your financials, and you have to debate whether that expense was an appropriate one or not. So we always like to do a percentage of GCI or of company dollar. And that's really the traditional way that's been going on for as long as I can remember, but that's pretty much it still in the market. And then it's a multiple of adjusted earnings. And Matt mentioned 3 to 5. What we're seeing with the smaller companies is that the buyers want to go in the 3s and the sellers want to go in the 4s. And so it's in the high 3s, little 4 for 5 million of GCI and under companies right now. So that's got a quick rule of thumb, but again, there's exceptions for quality companies because there's being less and less quality companies out there available. And so there's a premium for a quality company. And
Yeah, I think it's fair to say, one of the ways that WAV Group can help you is, if you are going to go into a transaction, whether we participated in it or not, but you're going to go into an earnout environment, having somebody who's had a lot of experience with earnouts and that can help you maximize the overall amount that you would receive through the transaction over a period of years is a service that consultants provide, and it really can make a difference. We've done well with that, so we can also help with complicated transactions where somebody hands you a 600-point workbook and says, could you answer these questions? That it's a full-time job. And if you're operating your business efficiently, like every broker should be doing today, you probably don't have a highly skilled person who can jump in and do that job. And that strings out the distance, can string out the transaction, and time can be your enemy. There's a lot of things that can go on. So use a consultant if you don't have the time and energy to do it. Matt, you guys are doing a lot of deals up in your area. How are you structuring those commonly?
I think similar to what George was just saying, I think the challenge today is that, we talked about seller, people who want to sell their business. They have, family, personal lifestyle reasons that they want to sell. They have, they want to grow. They want to be part of something bigger. Maybe they're stressed out. But then they think their company's not worth enough right now because we're coming off of quieter years and more challenging market, right? So, you know, I think it's even more important for those people to go out and get a valuation, because I think they might be surprised. And, you know, I think there's always been, you know, this balance between how much upfront and how much over time. Howard Hanna typically is paid, you know, more upfront than other people. Certainly more than we were doing when we were just Rand Realty. So, you know, there we were able to put a lot more cash into deals. Today, I think maybe the balance is pushing a little more towards the earnout, because if you believe your company is going to grow faster by doing this deal, you don't want to keep it so that, well, I'll keep it for 3 years, and then when the market comes back, I'll sell it. Well, if it's going to grow faster over those 3 years, you're basically with an earnout can sell it for what it's worth in 3 years and get all the benefits of doing the deal now.
Yeah, especially if you're the partner that you're joining is a company that's proven itself to compete high, you know, with great effectiveness in the market. You know, if you're merging with a company that's, you know, already taken market share away from you, the likelihood of you actually propelling significant growth in your business through that partnership is greater than if you were to wait and sell later, because your pie might be smaller. That's certainly a case. Now, Chrissy, you guys have done some extraordinary new deal structure recently, giving people like optionality on where they actually, you know, where the valuation gets pinned. I don't even know how to explain it. Well, I'll just let you do it.
Yeah, so the basic construct is not that dissimilar. Some consideration up front and some consideration over time. But given kind of where we are in the market cycle, there are a lot of sellers that are saying, why would I sell today? This is the lowest valuation I've ever received for my company. Or, you know, my EBITDA still hasn't recovered from 2022. And, you know, a lot of people have, I don't want to say PTSD because it's like the opposite of that, but all they're thinking about is their EBITDA in 2021 or their net profit in 2021, which is a year that may or may not be replicated. And it's really hard to think about valuing your business on a year that you probably don't see as reflective of kind of the true performance. So what we've done is kind of split the difference. So we'll give you some consideration based on the historical performance of the business. And then we put the optionality in the hands of the seller to say, at some point in the next 2 to 4 years, maybe you get to strike the earnout and say, this is when I would like to receive my final payment. And we do a look back on the period of time from that point in time to closing and strike the second payment based on performance of the business during, you know, those 2 to 4 years, rather than kind of a linear payment from there. And I think that's given folks some comfort in knowing that they'll be able to benefit from future performance and growth, to Matt's point, with the business, but also take some money off the table and protect the value that they see today.
Awesome. I want to remind the people that are on the call that if you have questions, put them in the chat area, and I'll get to those questions in just a second. But I would like each of you to just do a little wrap up. If you were talking to somebody about M&A today, what are sort of 3 or 4 key things that they should have taken away from this meeting and that they should be doing in their business right now? Matt, you can go first since Chrissy
I'll go first. They should call you guys for evaluation and buy your books.
Appreciate the endorsement.
That
George?
should go first. You know, I think that you know, it's back to the point kind of we made at the beginning that it's a great time to be looking to sell your business. I mean, I think there's certainly challenges. We're coming off of maybe not the greatest year, but I'm not sure we're seeing anything that says next year is going to look all that different. So the strategy of what you can do going forward to really maximize the value of the business, whether that means creative valuations or creative structures like we were just talking about, or what, you know, Hanna has been doing with the partnership model where you're still keeping a piece of the business, but you get to take some money off the table, or you're looking at succession. You know, do you have people who want to take it over? Do you want to keep all of the families investment in this one stock, or be able to take some off, but still have the next generation or the operators stay involved. There are options and there are buyers out there, and it's a success story to sell your business and to become part of one of the big companies across the industry. I think, we're looking at a world where you have to be either really small or really, really big. And everybody in between has to think about, kind of which direction they should be going as we move forward. But I'm having more fun now after having sold our business than I was before. And I'm doing very much the same job. So I think there's, it's not the end of the story when you sell your business and go in a new direction.
I love it. George, you have a few closing
Yeah,
thoughts?
I'll just give you one. So we work with many sellers, and when they will say, well, if the buyer would just close this office, they can make an extra X amount of money. If they would just do this, they can make extra amount of money. If they would just do this. And what our advice always is, no, do this now before the seller comes or the buyer comes in and does all the changes that you wanted to do. But if you can improve your profitability, as Matt said, think about the value of your company every day and every decision that you make. But in so many cases, you've got a list of 5 things that you really want to do to improve it, and you don't do it. And then the buyer comes in and they'll do all those things, and you'll feel really sad for that.
Chrissy.
One thing I didn't hit on, and I agree with everything that Matt and George said. I think that going into any conversation, really know why you're starting the conversations. What are your motivations to even contemplating a sale? Because that will be one, telling to you as a person, like, what are you trying to get out of that? But it'll also help somebody like me make sure that we structure a transaction that accomplishes your goals as well as ours. So really, have the discussion with somebody like Victor and George around what the value is, but also understand why are you even contemplating a conversation, so that we can make sure that we get across the finish line in the right way.
Know your why.
Well done.